So, what are the biggest misconception you hear about reverse mortgage?
The number one thing that people believe is they have to sign over their home to the lender. That doesn't
Mhm.
happen. They stay on title the whole time. Another one is it's expensive. And what I tell people is, this is not your traditional mortgage where
Mhm.
there's certain programs. This is a national program, and like I said, it's overseen by HUD, administered by FHA, and it's expensive because these are non-recourse loans. So you invest in commercial real estate, so you understand what a non-recourse loan is. But just in case your audience may not be familiar, a non-recourse loan is one where the borrower is not personally liable to repay it. The only
Mhm.
recourse the lender has is against the sale or refinance of the property. And
Mhm.
for that privilege or for that opportunity, the lender charges, FHA charges a 2% premium on the value of the home. So in a
Mhm.
$500,000 home, that's a $10,000 insurance premium that's being paid, which makes the loan expensive.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. Today, I have a very special guest, Kevin Guttman, with me. Welcome to the Real Estate Vibe Show, Kevin.
Oh, thank you. I'm glad to be here.
Likewise, I'm looking forward to learn about reverse mortgage from you. But before that, a little bit about Kevin. Kevin is a nationally recognized reverse mortgage specialist and the best-selling author who has helped thousands of seniors make confident financial decisions. With over 2 decades of experience, Kevin simplifies complex topics with clarity, compassion, and integrity. And today we'll be discussing unlock equity, build wealth, the power of reverse mortgage. So, just to let you know, a reverse mortgage allows homeowners age 62 plus to access a portion of their home equity as a tax free cash without selling their home or making monthly mortgage payments. It can free up income, reduce financial stress, and create the flexibility to enjoy retirement, invest, or cover expenses with peace of mind. It can also be a powerful tool for building generational wealth when used strategically. Let's dig into today's conversation to explore how this often overlooked financial tool can help unlock long term wealth for you and your family. So, Kevin, let's start with this. Can you walk us through what is a reverse mortgage and who is it designed for?
Yeah, that's a great question. So the very first reverse mortgage was taken out in 1961 by a widow in Vermont. Her husband had passed away and she couldn't afford to continue to make the mortgage payment, which is very common actually when one spouse dies or passes away. It's hard for the other spouse to continue on one income to make a mortgage payment. Anyway, she knew the local banker because her husband was the football coach. Banker played football for the football coach. Banker went to his bank and said, "Can we allow this widow to remain in her home and not have any more mortgage payments? We'll suspend her mortgage payments. We'll take payments from her equity each month." And thus the very first reverse mortgage was born. And Vinky, for 27 years, the industry was unregulated. And
Mhm.
unfortunately, some people got taken advantage of. And to this day, people have this negative perception about reverse mortgages. But now it's the safest mortgage anybody can get. Many safeguards are put in place, and seniors are protected. And our government's been overseeing these since 1989. So that's a little history about how the program works. You asked who it helps. It helps somebody 62 years or older who's a homeowner, wants to remain in home or at their home and age in place, maintain their independence, retain title of ownership. They always stay on title, just like a traditional mortgage. They never go off title. And they can maintain their independence and entertain the lifestyle they've worked for. And most importantly, gain access to their equity, which is not taxable.
Oh, that's a great information. So you mentioned something, you said negative perceptions. So what are the biggest misconception you hear about reverse mortgage?
The number one thing that people believe is they have to sign over their home to the lender. That doesn't
Mm-hmm.
happen. They stay on title the whole time. Another one is it's expensive. And what I tell people is, this is not your traditional mortgage where,
Mm-hmm.
there's certain programs. This is a national program. And like I said, it's overseen by HUD, administered by FHA, and it's expensive because these are non-recourse loans. So you invest in commercial real estate, so you understand what a non-recourse loan is. But just in case
Yes.
your audience may not be familiar, a non-recourse loan is one where the borrower is not personally liable to repay it. The only
Mm-hmm.
recourse the lender has is against the sale or refinance of the property. And
Mm-hmm.
for that privilege or for that opportunity, the lender charges, FHA charges a 2% premium on the value of the home. So in a
Mm-hmm.
$500,000 home, that's a $10,000 insurance premium that's being paid, which makes the loan expensive. And that's why people think they're expensive. But it does what other loans don't do. And we'll get into that more, I'm sure. But yes, that is one drawback. It's an expensive loan. That's true.
Thank you for sharing that. But you did mention something. You said non-recourse loan. The only recourse is the property, right? Your primary residence where you're pulling the equity out. So what if the market shifts, like the kind of economic times we are right now, right? Very strange, kind of tricky time right now. So if the property value goes down, so what are the consequences in that kind of
Right. So, how much somebody can borrow is based on three factors: their age, at least one borrower needs to be 62, or if it's a
mhm,
property above a million, both need to be 55, the interest rate, and the value of the home. So, let's say somebody can borrow between 35 and 45%. Now,
mhm.
if what you're offering happens, which did happen in 2008 and 9, the market retracted. If that were to happen again, the equity is protected. It can't be cut. They can come with a reverse mortgage line of credit. That credit line cannot be affected at all. It can't be frozen, can't be cut, payment can't be demanded. Like a HELOC, a home equity line of credit, all of those things can happen with a home equity line of credit. None of those things can happen with a reverse mortgage line of credit. So, in a way, it's a protection of about 35 to 45% of somebody's equity if they have a reverse mortgage in place and if a market correction were to happen.
Okay, so the question comes to our mind here is because you mentioned few things. You mentioned key lock, and then also we're talking about refinance over here a little bit. So what is a reverse mortgage actually is, I need to understand that. And how is it different from HELOC? HELOC is a home equity line, right? And then how is it different from cash out refi as well? Because you're talking about the way I understand is reverse mortgage, you're getting pulling the equity out, you're getting a loan against your equity, right? So, and then, but you're not paying that back because the bank or the creditor thinks that someday when it matures, they're going to be selling the property and they're going to be getting their money back. So I wanted to understand that, like, kind of end to end, how exactly it works and how it's different from the traditional models of refinancing cash out and also the HELOC or the home equity line.
Yeah. So there's three main uses of how people use them. The most popular one is to make the monthly mortgage payment, the principal and interest mortgage payment optional. That's how
Mm-hmm.
most people use it. About two-thirds of people use it that way. And then when you eliminate that payment, it frees up, $1,000, $2,000, $3,000 a month. It's a game changer for some people.
Mm-hmm.
The second way people use it is probably how your clients will use it, which is to access equity. And
Mm-hmm.
we were talking a minute ago before we went live about how if they can do that, they can really leverage that equity and build more wealth and have more to pass on to their family and
Yeah. Mm-hmm.
legacy or whatever they're interested in. The third way somebody can use a reverse mortgage is to increase their buying power. So, Vinky, you have people that have lived in their homes 20, 25, 30 years, raised their family there, but now they're in a different stage of life. The kids have moved out and maybe they don't like that neighborhood anymore. Maybe they want to move closer to family. Maybe they want to move to a different state, all kinds of things. They can buy a house and the lender will put up 35 to 45% of the value of the home. And here's the difference. This is actually answering your question now. There is no monthly mortgage payment required with a reverse mortgage. With a cash out refinance or home equity line of credit, a payment is mandatory. With a reverse mortgage, it's optional. That is the biggest difference. The other difference is those loans, traditional mortgages, home equity lines of credit, those are loans where somebody signs their personal name. They're personally liable to pay it back. With the reverse mortgage, it's non-recourse. There's no debt that can be passed on to the borrower, to their estate, or to their heirs. Those are the two main differences.
So why this reverse mortgage have a bad reputation or a bad name if it's that easy that you can pull the equity out at 62 plus? I mean, this is one of the, I think, we call the requirement that you need to have, right? If you're able to pull it out, and then there is no limitation how you wanted to use those funds. Like you mentioned, you can reinvest that too, and you can make money on that. That's tax-free money. Yes, definitely when you're making money off of that, you might pay some tax on that on your capital gain, but on the original equity that you pulled out, that's tax-free, right? So why it has a bad name? Why people are not utilizing this vehicle to generate more money, or why it's not being used as well of the wealth building strategy?
Yeah, I think there's a few reasons. I think one, the government isn't very good at promoting their programs that they have. They don't get the word out about the programs that they offer the citizens. Two is you have financial pundits and media personnel like Dave Ramsey and Susie Orman who are out there um, misrepresenting the program to people. And a lot of people listen to these folks and they're just not accurate with what they're saying. I think another thing is you have financial planners who are on one side of the balance sheet. They're on the asset side of the balance sheet. Mortgage is on the um, debt side of the balance sheet, and they don't take the time to understand how that can work. So really what it comes down to, Vinki, is we need to do a better job of educating people, both clients, prospects, partners, so that people know whether they end up doing one or not. They should understand how it works and see if it could benefit them. And by the way, the number one thing I hear from people when I sit with them and explain what it is this sounds too good to be true. What's the catch? That's the number one thing people say. And I say, there's no catch. You alluded to it a second ago. It's a deferred interest loan. It's an insured loan. So the lender is going to get all their money eventually. When the last borrower moves out, the loan has to be repaid by sale or refinance of the house. So the lender is willing to wait for their money. It's accumulating interest. It's a deferred interest loan. But in the meantime, the borrower gets to stay in their home, not have a monthly mortgage payment, can access their equity, and as we've alluded to, can actually build their wealth by taking that money out that's dead sitting there doing nothing and go use it for something else, buying more real estate or other investments or things like that. And by the way, there is one restriction. The only restriction the government puts on accessing the equity is they cannot purchase an annuity, because really what they're doing is they're already unlocking that equity and creating an income stream for them if they need it. So the government doesn't want them to take that money and go tie it up for so many years or so many more fees, right? So that's the only restriction that the government puts on a borrower, is they cannot buy an annuity with those proceeds.
So earlier you mentioned that you said it's a very expensive loan and there is an insurance, like you were saying, you were getting, you have to pay 10% annualized. That they have to pay, or that gets kind of accrued too over time? How
Yeah,
does that?
it's 2% of the value of the home.
Or
So
2%, 10%, sorry about that.
the vast majority of the fees are rolled into the loan, except for three things. These are all third-party fees. They have to pay for a credit report, which is about $100, an appraisal, which is about $700, 800, and the counseling, which is 150 to 200, depending upon the agency. So out of pocket, they're out of pocket maybe $1,000, but all the rest of the fees are rolled into the loan. And then yes, they do accrue interest. That's true. But at the same time, quick story. I was at a senior expo giving a talk about reverse mortgages and how they can be used. And this lady came up to me and said, I don't need to come to your seminar. I own my house free and clear. I said, congratulations. There's only about 35% of the country that have been able to do that. Good for you. That's great. I said, what do you think your property's worth? Oh, probably 500,000. I said, that's awesome. I said, let me ask you something. I said, when you were working, did you have a 401k or an IRA? Uh-huh. I said, well, why? Well, I wanted to invest and grow money over time to when I get to the point I didn't want to work anymore, I could live off that income. So I said, you invested it to grow it. Is that right? She said, yeah. I said, and yet you're okay having $500,000 of debt equity, earning 0% return on investment. You're okay with that. She goes, I got it. I'm coming to your seminar. So that's the whole point is a lot of people have a good amount of wealth in their house that they can't get to. The only way any of us can get to our equity is sell our house, pay the realtor 6%, 3 and 3, do a cash out refinance or home equity line of credit, have a mandatory payment, or do a reverse mortgage, which is the only tool, financial tool, loan where there's no repayment required by the borrower.
Oh my God, this is kind of mind-boggling. But the question comes to my mind is now, is it like really just a last resort tool? Because you used this word earlier, like people look at it as a last resort. Is it really a last resort tool, or can it be more strategic? Like we were talking before the recording, that you think we can kind of build on it or kind of look into it more like a generational wealth building strategy, or one of the strategy that we use for the generational wealth building? What do you think about that?
I would say this, historically, it has been a last resort tool. Okay, I'm broke. I guess I better get a reverse mortgage. I'm a loser. I ran out of money. But the truth is, I'm helping lots of people that don't need it, but they see what you're saying. Wait a second. I've got all this money here doing nothing. Let me tap into it. Let me start giving it away to charities, to my kids, to my grandkids, help my grandkids buy their first house, give a down payment, buy a second home, buy investment property. So I think it's starting to shift to what you're suggesting, which is people are starting to understand, wait a second, this can really I can exponentially grow my wealth. Here's an example. 12% of people have long-term care insurance in the country, 12%. About 2/3 of us are going to need some form of long-term care. As we get older, we're going to need to bring people into the home to help us bathe, to help us cook, to help us get dressed, to help us go to the bathroom, take a shower, run errands, etc., clean our house. We're going to need some more help as we get older. People are living longer, and they're going to just need more help. 12% of people have long-term care. 2/3 of people are going to need it. What if you took the equity from your house and you just paid the insurance premium for long-term care? It can be a combination of long-term care and life insurance policy. So now people say, well, I'm concerned about giving up equity to my kids or to my heirs, but really you can actually give more money to them, also tax-free, and you're not taking on the liability of having those medical expenses. You may be seeing that study by Fidelity that a healthy 65-year-old couple is going to spend $315,000 in out of pocket in healthcare expenses. That's crazy. Why not
It
shift
is.
that risk to the insurance company? So there's just unlimited ways people can use this. And I'm with you. People should really start to think about, wait a second, let me unlock and access this money so I can do more good for my family, less burden on them when I pass away, and ultimately leave even a better legacy.
I think the question here is many people see their home as their nest egg. It's like my home because they have a lot of attachment, emotional attachment, a lot of sentiments. Like kids, you mentioned kids born here, grew up here, even the love bias is like, kind of their abode, basically. So how do you actually, from your experience, let me ask you this. How do you help your clients view this as a tool for like more cash, or could be cash used strategically for some other investment where they can make more money?
Yeah, we have to really walk them through the process of what do they want ultimately. And you hit the nail on the head. They want to help their kids. They want to help their grandkids. So one of the questions we ask is, do you want to help them while you're alive or after you're gone?
Mm-hmm.
You want to help with the warm hand or the cold hand?
Mm-hmm.
And when people can start to see, wait a second, I can actually start giving away my estate while I'm here and give guidance to my family or my friends or my charities while I'm around, see the good that it does, have a better impact, a bigger impact, use more leverage, then they start to click over and say, okay, I think it's worth it. And you're right. Our homes are very emotional. We've spent years there. There's lots of memories, and it's hard. It's hard for people sometimes to shift over from, I would call it the emotional side to the I don't want to say logical side, but to the strategic side, where they can actually do more good if they can reframe it.
Yeah, because I feel like, people at 62, like in 60s or 72 these days, they are very healthy and they are very, very alert mentally too. And I don't see anything negative about the reverse mortgage if they use it strategically for their benefit. That's the point of view I'm thinking about because it's not the same, like you mentioned, you got elderly, you need a lot of external help to help you survive. But that has been pushed back in the later years, maybe after 80s now, because of the way we are growing, our well-being is, the way our lifestyle is, the way people are living. I see a lot of people, they are very healthy at 60 or 70, they are not like that old that they need that kind of help at that time. So if we give them some kind of tools where they can use these tools to generate more wealth for themselves or leave a legacy for their heirs, I think that might be really beneficial. What do you say, from your perspective or your experience?
Yeah. So you've been around finance for a long time with your career and teaching and Bank of America and the things you've done and now real estate. So you might remember when we were in our 20s, financial planners told us start investing now. You'll never get this decade back. You'll be so
Mm-hmm.
far ahead if you start in your 20s, remember? The
Mm-hmm.
same thing is true with a reverse mortgage in your 60s. The earliest you can get a traditional reverse mortgage is 62, a jumbo
Mm-hmm.
proprietary reverse mortgage age 55. But we'll just
Mm-hmm.
say 62 for today. So now somebody takes out a reverse mortgage line of credit. Let's say they own their house outright, and then we'll
Mm-hmm.
say it's worth a million, and they can access about 35%. So
Mm-hmm.
350,000 is in the line of credit. And one strategy might be they don't do anything with it. It just sits in the background. It's kind of a rainy day fund, but it can come with a line of credit that grows by compound interest, tax free. You draw the proceeds out; they're not taxable. It's insured. It's protected from any market correction. So we'll say on average it's going to grow 7% a year, which is probably that's what it is today. But just we're going to say for the next 10 years, it's going to grow
Right.
by 7%. And you know the rule of 72, how
Mhm.
fast money can double, right? You take the interest
Right.
rate divided into 72. So we're going to say in 10 years that 350 is now 700.
Mhm.
They're 72. Now they have $700,000 available to them, tax free. They can do whatever they want with it except buy an annuity. And then they're going to let it ride another 10 years. Now they're 82. Same house, same same scenario. Now they've got $1.4 million available to them to access to do whatever they want. Well, how much good could they do with their family, with the charities that they believe in, with, like we talked about a second ago, building wealth, building legacy, acquiring more assets to pass on to children and grandchildren? It's amazing. But we have to think differently. We can't think about I have to hold on. This is my house. This is my equity. I can't do anything with it. We have to be a little bit of a risk taker, although I really don't think there's much risk in this particular strategy. I mean, you can't lose money when it's guaranteed and insured and protected from the market. I mean, it's only going to go up by compound interest. But let's just say somebody's very conservative and that's all they wanted to do. Okay, in 20 years, they went from 350 to 1.4 million if they haven't tapped into it. That's just one example. And I have clients
That's
who've done this, you know. Um, I wrote another book. You talked about my most recent book, A Reverse Mortgage Changed My Life. But I wrote a book before that called The Swiss Army Knife of Retirement Cash Flow. And both of them are just stories of how people have used equity in their home to improve their lives in primarily five areas: lifestyle, housing, medical, dream, and legacy. And I always tell people, you know, I think sometimes people get into these retired years, these golden years, and they kind of stop dreaming, they kind of stop living. And it doesn't need to be that way. These should be the best years of your life, where you're the most productive, where you're helping the most people and doing the most good. And it can be because you can have access to a lot more money if you tap into it.
I like that. I really, really like that because this is your second inning or the third inning, maybe, because you've been there, done that, did your share, your kids, your jobs, everything. So this is the second inning for you. So you basically you can start from anywhere. You can just follow your dreams. Whatever you didn't achieve earlier, you can do it now. Thanks for sharing that. So let's talk about the tax implications, because we've been saying that or discussing for a long time that it's all tax-free money because we didn't doing the reverse mortgage, because basically it's a debt. So I wanted my listeners to understand that, because you're loaning, you're getting a loan against your equity, basically, it's a debt. So you don't pay any taxes on debt. But when you take that debt and you reinvest that debt, there's going to be capital gain. So what are going to be the tax implication? Are you aware of that a little bit or no?
Yeah. So sometimes people ask about if they can still take the mortgage interest write-off. If you accumulate and pay more than $600 in a year of mortgage interest, then yes, you can write it off. But you got to remember this too: with the Trump tax cuts, the exemption is so high now, very few people itemize anymore. But one strategy could be you live through your line of credit. For example, let's say your household expenses every month are $10,000. Well,
Mm-hmm.
you just take you take $10,000 out of your line of credit, they deposit it in your checking account, and now you live off that money. But
Mm-hmm.
then more money comes in, you pay it down. Same thing, you draw it, you pay it down, you draw it, you pay it down. So basically, you're living out of your line of credit and you're not touching your investments, you're letting those grow. So that's one way people can do it. And then they would be able to write off that interest because they are paying interest every time they draw money. There's interest charged. Whatever the balance is, that's how much interest is charged. So, but yeah, if they do take their money and invest it in a vehicle that is taxable. By the way, there's only four non-taxable um, entities: Roth IRA, health savings account. Bonds are questionable depending upon what state you live in because they can be taxed at the state level. And then equity from a home. Those are not taxable events. Also,
Mm-hmm.
life insurance proceeds, if you borrow from life insurance proceeds. Those are the only non-taxable things that people can tap into. Annuities, too, in some cases, wouldn't be taxed. But if you invest in real estate, and we talked early on about how we're both fans of real estate. I grew up in a real estate home in Orange County, California. You invest in real estate now. I invest in real estate still. Um, there's a lot of tax advantages to real estate. So I
Yeah,
just
it
think if
costs.
people are shrewd and they think through a plan and they have help, it's possible where they can minimize their tax burden and build wealth using leverage.
The same time. Because, yeah, I mean, I'm thinking loud here, because there might be a way that you can be just have this life without any financial stress. Because, like you're talking about, you can get a home equity line against your equity, and then you can pay your expenses, but you can have some surplus cash that you can reinvest too. And from that, you can create a passive income stream for yourself. There's another stream of income coming to you for, howsoever long the investment is, could be 5 years to 10 years. And then eventually when you exit that, there could be some profit, but then the real estate investing, it comes with some tax benefits as well, because through the depreciation or the bonus depreciation, there might be some losses, paper losses that you can get that you can write off against that. So that could be beneficial. Wow, you're just opening my mind so much on this reverse mortgage and how we can use this as investment or wealth generation strategy as well. So here I'm going to ask you another question. Can someone use the funds from the reverse mortgage to invest in real estate syndications? Or it has to be like something more like you mentioned, you can put in Roth IRA and you can go to maybe REITs or you can go to like DSTs or something like those kind of vehicles.
I'm a fan
Or
of
can they
all
use
of
the private
those.
placement?
Yeah, I'm a fan of all of those things. And yes, yes, and yes. I have a client right now. He's moving from his primary home. He's buying a fourplex. He's going to live in one of the units, and then he won't have any mortgage payment. He's using a reverse mortgage. He's putting a large down payment down, about 65%, and buying this fourplex. And then he'll have the rent from the 3 units, plus he lives for free basically.
Wow. So, but this free thing, I don't understand that because I know that in real life, nothing comes free. So, what is that free? Does it like it's like a really big check at the end, that you get hit with, or your ears get hit with, when you exit the property or howsoever, whatever the exit looks like at that
Yeah,
point. So, if
yeah,
you can
that's a
walk
great
us through
question.
the experience.
So, so think about it like this, Vinky. Somebody's borrowing 35%,
Mm-hmm.
and they're being charged interest of, we'll say, 6.5 today, 6.5% on 35%. But the appreciation, and you and I know, and your audience knows, the only way we realize appreciation is when we sell or refinance. It's kind of a phantom number, right?
That's true. Mhm.
Okay. So, but the property is growing, we'll just say on average 4% a year. Some markets it's better, some it's less, but we'll just say on average 4% a year on 100% of the value of the home. So there's almost always money at the end for the heirs.
Mhm. Oh. Wow. So because you're taking the portion of the equity, like you said, 35%. So you are never like, when you refi, maybe that's what I had in my mind. Let's say if I refi my home today, so whatever equity I have, like maybe half a million, I should be able to pull everything out. But in turn, my mortgage payment is going to be bigger, right? The monthly payment is going to be larger than what I have today. Then maybe the insurance will go up because it's a revaluation of my property. It's going to be different numbers than we had before. Maybe that's what I had in my mind. And that's the reason I had this question on the reverse mortgage side. But you're taking the portion of the equity, not 100%, right? Because there's
Correct.
always going to be money that's going to be set aside at the exit.
Correct.
Yeah. So what should people watch out if or when they consider reverse mortgage?
I always say this, and you've probably heard of people that have won the lottery, and 2 or 3 years afterwards they're worse off than when they before they won
Mm-hmm.
the lottery, because they're not used to handling large sums of money. So
That's
people
true.
say, well, who shouldn't do it? Somebody that really doesn't manage their money well now is only going to get in more trouble. They're going to get in a worse predicament now. So and I tease sometimes,
Mhm.
meet with these older women, they're single widows, and I'll tease them. I'll say, now you're not going to go down to the casino and gamble all this money away, are you? And they laugh. They say, no, I'm not a gambler. And I say, no, I'm kidding in a way, but I'm also serious because I really want you to use this money wisely. Treat it like it's um, your last, the last money you have on earth, right? And be very careful with how you use it, because you've probably heard of people getting scammed. These
Mhm.
people getting scammed out of their money. I just talked to a lady last week. Her own son scammed her out of $200,000 of equity in her home. Her own son. And is you just wonder what are people thinking? I mean, how can they do that to their own mom? Single gal, and raised her kid, and it's just terrible. But who shouldn't do it? Somebody that doesn't manage their money well now. Somebody that isn't going to stay in their home for at least 18 months because we want them to recoup the fees for the loan. Somebody that's probably if they're terminally ill, and they're not gonna live that long, we don't want them to get this loan where they're not going to see the benefit of it, right? We really want to put people in a better position than when they started with us. So those are the three big things that we have people look for. And then the last thing I should comment on, and I know we're running short on time in a few minutes here, but people always want to know what happens at the end. It's just like a regular mortgage. You get a payoff, you pay it off. Whatever money's left goes to the heirs, to the estate, to the borrowers. And there's almost always money at the end. And what triggers that? When the last borrower moves out, that's when the loan becomes due.
Hmm. So what I'm hearing is, it might not be a bad idea, but you gotta have a strategic plan together. Like for a business, any business, you create your business plan. So this is something that you're doing with your home or your primary residence, and then you're trying to build wealth maybe with whatever tools you got. So you gotta have a strategic plan in place, like this is the present state. And that's the future state I wanted to get to. How do I get there? So create your own small little GPS system, that you call a strategic plan to get there. And I don't think you cannot achieve that. Is doable. That's the way I look at it. So at this time, I'm going to ask you, what trends are you seeing in how savvy retirees are using this reverse mortgage strategy today? Because there might be people out there already using this strategy as one of their wealth building strategy that we're talking, and we are not aware of that.
Yeah. So I've seen my clients I just closed in January a client in Michigan, and he used this to be as a bridge for Social Security. He was 62. He didn't want to work anymore, wanted to access his equity until age 70 when he would take Social Security and increase, 8% a year, I think, getting more Social Security. I've seen people use it as a bridge for Medicare. They get it at 62 and they're getting Medicare at 65. So they have some health care things they got to take care of and they have money to pay for that. I've seen people buy second homes with reverse mortgages. I've seen them buy businesses with their family. They wanted to help a family member start a business, so they took equity out to buy it. I've seen them use it for pleasure. I have a gal that was a retired nurse, and she said, I always had a dream to travel around the country and visit national parks. Her financial planner sent her to me and said, get a reverse mortgage. She took the money out, bought one of those Sprinter vans. You've seen those Sprinter vans, custom made. And she
Right.
and her little dog went all around the country and visited these national parks. And I just talked to her the other day. She's actually selling her house, still equity in her house, and she's moving closer to her son in the Northeast. So, that's why I'm saying is people need to keep living. You've seen this happen, Vinky. When people retire, they stop working, they kind of lose their purpose and they don't live that much longer. They're not
That's
connected with people anymore. People got to keep living. You just said it a second ago. They have to have a vision for their life and this part of their life. What are you going to do? How are you going to continue to contribute and help people? And who's your community? Who are you gonna what are the friends you're walking with and learning from? And so I want people to keep going, and this will help them fund it. This will help them fund the dream they have for this stage of their life.
great. I love that. Oh my God. So last question. What is your number one piece of advice for turning home equity into lasting wealth?
Learn about it. Don't don't
I love that.
don't rely on the internet, which has inaccurate and outdated information. Don't listen to Dave Ramsey. He's good with the debt snowball. He's good with that. But some of these
Mhm.
other things, like especially reverse mortgage, he's not current. He's not accurate. Susie Orman recommends that a client should take a HELOC over a reverse mortgage. Let's just contrast that for a second. HELOC
Uh-huh.
has a 10-year draw and a 20-year repayment. A reverse mortgage line of credit's a 150-year term. Which one's better? Reverse mortgage. HELOC has a mandatory payment. Reverse mortgage, no payment. HELOC pays interest. HELOC can, you have to say pay some interest, but you can also earn, or your line of credit can grow by compound interest and build wealth for you, tax free. This one's taxable. Which one's better? It's like baseball analogy. I don't know if you're a baseball fan. You live by the Dodgers, right? I love the Dodgers, grew
Yes.
up in Orange County.
Mhm.
But one of them's a major league World Series champion, reverse mortgage line of credit. The other one's playing double A or single A ball, right? It's baseball, but it's not at the level of reverse mortgage. That's the HELOC.
Wow, I love that comparison too. Thank you for doing that. But I don't know, I'm just kind of blown, but at this time, I wanted to ask you, is there something that I didn't ask you about reverse mortgage because I might not have enough insight into it? So share that with me, what I missed asking you.
I think I think you really covered the main points actually really well, Vinky. And I can give you some sites that I have that people can go to if you want, that they can do some research and some homework that is the truth. Now you say, well, they're your sites. Yeah, but I'm putting truth out there on my sites. I'm not putting a bunch of fake stuff. It's accurate information. If people want to go, and there's videos and their consumer guide and websites I can give you that people can go and do their own research and not ever have to reach out to me if they don't want to. They can just go stealth and read and watch whatever they want. But if they want to, I'm happy to look at their numbers for them. But I think people need to learn about it for themselves and see how it can help them. And like you said, have a plan for leveraging this equity that's just sitting there, oftentimes doing nothing.
Thank you so much. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You're going to answer it in 1 word or 1 sentence only. Are you ready?
Yeah.
Okay, the first question is, what is one of the most important things you have learned in your life, and how did your life change after learning it?
Be generous.
I like that. Share one good book that you like to recommend to my audience.
I'd recommend my book, A Reverse Mortgage Changed My Life.
Okay. Share one more other than your book.
I'm a big fan of self-help books. So anything by John Maxwell I like. I like Stephen Covey. Those kind of folks have helped me a lot just in my life, how to think better and be more of a productive citizen.
Great. I like that. So in 1 word, what does life mean to you?
Helping people.
I like that. What is your biggest passion?
Probably helping people be financially free.
That's a good one. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Be intentional. Know what you want and be intentional.
I like that. Thanks for sharing that. And I really enjoyed our conversation. So share with us, how can people reach out to you?
So I have a couple websites I can recommend. Reversemortgagerevolution.com has a lot of great tools and calculator and videos and FAQs and things people can download. I have a consumer guide on that site as well, which answers a lot of questions. And then for the jumbo properties, anything over $1 million, jumboreversemortgage.co, jumboreversemortgage.co. Those are a couple places people can go and just learn and read and get educated about this amazing program.
Thank you so much, Kevin, for sharing your insight with us. I really enjoyed our conversation.
I enjoyed it so much. Thank you for having me.
Thank you, everyone, for tuning in to the Real Estate Vibe Show. Don't forget to subscribe, leave a review, and share this episode with anyone looking to elevate their real estate investing game. Until next time, stay focused, stay inspired, and keep building your real estate vibe. Thanks again.